So one of the biggest problems that I see people make when they're trading is they just turn up to a market and they expect somehow to be able to understand exactly what is going on and why. They're turning to each individual market saying, well, I think this is going to happen, that's going to happen. And the problem is that's probably one of the hardest things to do, is to turn up blind without any sort of indication as to what you think is likely to happen. And you're sort of thinking, well, how can you anticipate what is likely to happen within a market? Well, what I'm going to do in this video is show you exactly that. We're going to put a framework around it. But one of the key messages that I want to bring across to you on this video is that you don't have to trade every market. You can just look down the list of markets, pick some that look appealing, and then do a much better job of pulling off a decent trade. Every strategy has a market, and every market a strategy. And what I try to do in a lot of videos is to pinpoint the markets that are of interest to you and the strategy that would go with that. The hardest thing to do when you're actively trading is to turn up to a market and just sort of go, what's happening here? What should I do here? How should I do this? It's much easier to profile the markets, look for where those opportunities are likely to occur, and then put that strategy into the market. And you're actually under no obligation to trade every single market. If you have the right strategy and you can find some markets within which you feel comfortable deploying it, then there's no reason why you just couldn't do a few trades over the course of the day, and that would be suffice. Trading every single market, doing something in every single market is a skill that you can build up over time, but it's no obligation to do so at the start or when you're trying to learn to trade the markets. So let us have a look at a set of markets. We're going to pinpoint some opportunities and actively trade them. And what you'll be able to do is you'll be able to understand why we've picked those markets. You'll be able to understand the framework that we're using. And once you've done that and you see these markets in future, you'll know roughly what to do. And over time, you should get better at spotting these opportunities and actively trading them. So if we look at the type of race, you get this typical pattern that occurs where you get maidens and novices to start the card, then we move into handicaps, and then you'll get some hunter chasers and national hunt flat races and stuff like that at the back end of the card. But the middle of the card is nearly always handicap races. And over here you can see we've got a mixture of different types of races today. So you can see here we've got a 108 at Lingfield, which is crazy. But we've also got some shorter prices over here. Again at Lingfield, and then we've got at the beginning of the card you can see we've got a maiden hurdle at near on threes. Then we've got something at almost bang on twos, which is a novice handicap chase, and then you see we've got a maiden at 2.2, so you can begin to get a feel for each of these races and which ones you would preferably target. And depending upon whether you want to nip in and out of the market on a regular basis or go for one big move, most of the clues are there when you look at the racing card at the start of every day. So when we're looking at the race card, we're looking for sort of two things, really, two key things. The first one is the type of race that we're looking at. When we look at maidens and novices, they tend to have a great deal of uncertainty within them. And as a consequence, you tend to get the price moving around a fair bit within those markets. If we're looking at a maiden race with horses that have not raced before at all, that's the maximum amount of uncertainty that you can get. But generally speaking, both maiden and novice races tend to produce quite big moves. And that's exactly what we want for the strategy that we're going to deploy. We're going to jump on one of those moves, trade out of it, and make a little bit of money. And when we look at the other factor within this, we're looking at a set of odds. We're looking at the odds of the favourite, and we're sort of saying to them, which one of these races is most likely to produce the biggest movement in odds, because that gives us a trend to hop on the back of and actively trade. So when we look at something priced at odds of 2, that's the midpoint within the market. If you work out the implied chance of a horse winning at odds of 2, it's 50%. So it's effectively a coin toss. It could win, but it also could lose. And it's right down the middle. It's a 50-50 chance. And that tends to produce the biggest traded ranges. That's where the biggest amount of uncertainty is within the market. Makes sense, doesn't it? But as you move away from those odds, then that uncertainty fades away, and the traded range and the amount of average movement that you're going to get is going to be much smaller. If we look at much larger odds, it's likely to be on a handicap race, and there's basically nobody knows who's going to win that, so the market just can't make its mind up and more or less sort of flatlines. Well, it never completely flatlines, but you know what I mean. The traded range is smaller and there's less certainty within those moves. When we look at the other end of the market at very short prices, you tend to find that nobody's willing to sort of oppose a horse that's 20 to 1 on or something, and therefore the market doesn't have much price movement there either. So that's why we're looking at those odds of 2, because that's the maximum variability that you're going to get in the market, the biggest traded range, and hopefully a trend that we can jump onto. So let me set this up for you. We're going to use a really simple strategy, and that is we're going to look at the favourite on each race, and we're going to say if it's at the top or the bottom of its traded range or very close to that, we're just going to go with the flow, go along with that. So if it's at the top end of its traded range, when we arrive at the market, we're saying the market doesn't particularly like it. And at the bottom end, we say that the market really loves it, and then we're just going to jump on the back for a small little trend. Now, there are several elements here, one of which is that we're only going to do this on the races that we have discussed already. But also, we're aiming to take advantage of all of the activity that takes place in the final 2 minutes. We're sort of saying, if the market really loves or hates this particular runner, we're just going to jump on the back of that trend and get a little bit out of that. And what I suggest when you're learning to trade or you're trying to develop a strategy is you come up with a simplistic strategy like this, and then you get better and better at spotting the markets where this is likely to occur. So we're adopting a very simplistic approach here. You wouldn't go and do this in every single market. Ideally, you would approach this strategy with a view that you're going to identify markets where this is more likely. And we've done the first bit for you here, which is we're identifying markets where there is going to a move. And then the second bit would be you would turn up to a race and then you would evaluate whether this is actually going to happen or not. And you can use whatever tools or any hints and tips that I've given you in the past to be able to do this. But if you keep on practicing this in the same markets, then you'll get better and better at doing it. And on this particular day, I looked at these two particular races that were going off next to each other, and I thought, well, actually, these are set up at the opposite end of the spectrum for this particular type of strategy, and they probably stood a good chance of working. So let's see what happened. So what you'll see me do in this market is slowly build an order. And when I tend to trade, because I can't pinpoint the exact bottom or top or the correct entry point or whatever, I tend to feed trades into the market. So that's what you can see I'm doing here is I'm just dribbling small trades into the market to build a much bigger trade. And the reason that I'm doing that is so that it's not obvious that that's what I'm doing. Now, to a certain extent, you will see that show up in the volume figures on the right of the ladder. But ultimately, it's very difficult to establish exactly what I'm doing and the position that I'm sort of taking if you feed those orders in slowly. And if you look at the net stake, you can see the amount of money that I'm committing to the market, because the net stake is showing us at this moment in time that we need sort of £400-500 or so in back orders to be able to close this position out. But I'm just slowly increasing the amount of money that I'm committing to this market on the basis that we are going to see the price sort of move up a little bit. But I'm not looking to be precise. I'm not saying that this is definitely what's going to happen. This is definitely the price that I need to be at. I always adopt this approach of just gently feeding money into the market, getting it to a position that I feel comfortable with, and then I put the closing positions in on the other side. And you can see that I've spread out a lot of these closing positions. And again, I'm not looking to be precise here. I'm just sort of saying let the natural volatility within the market take those prices out. And you can see on the left hand side the green is sort of a little bit bigger. That tells me how far the market needs to go down if I'm going to make a loss. So if it starts to hover or look like it's going to go in that direction, I'll probably start speeding up my exit. But other than that, I'm just going to feed in. You just saw a large order come through there. I'm going to feed in orders on the other side, and that will just gently take my position out. And if the price goes up, then I'll obviously get a reasonable trade out of this. And once the positions are established within the market, if you look at the top of the ladder, you can see in the yellow how much money I've got committed in closing positions, about £500. So I've just dropped another order in there to try and balance out that yellow figure with the net stake. You can see the two here. And when I've got enough orders in the market to close out the net stake, then those are all my closing positions within the market. But what you can see here is as the price is slowly moving out, That green space on the left is gradually moving down, and that means I'm more and more likely to exit this trade for a profit. Not a massive move, but nonetheless it is a move. I have to go all the way down to 196 in order to be a loss. So it's just a question of managing these orders out. And as we get closer to the post, I'll speed up that process and just cancel those orders above because I no longer need them. So you can see it's just about to finish closing that position out. That's left us, if I just tidy up a little bit, a total trade value of £81 or about 30 odd pound fully hedged, which is what I will take. But you can see it did actually sprint away a little bit more towards the end, so I may have been able to hold on for a little bit longer and got a slightly better trade out of this. But that's the way the cookie crumbles. I just wanted to make sure I was out by post time. So we've got an interesting setup here in that we're 2 minutes before the start of the race. We're at the bottom end of this favourites current traded range. But the interesting thing is the race is actually delayed. And the funny thing about this is you do actually sort of get a double bubble within the market. So if this price sort of pushes down and gets towards 2, then if it breaches 2, there will be a reasonable move, you would think. But yeah, you know, we're getting involved in the market at this particular moment in time. There's still a fair amount of time until the true off time. And if we keep an eye on the total performance data feed from the racecourse, we can still see that the horses are in the parade ring. So we've got plenty of time to make this particular trade work. Because we can actually see what's going on course, we've got the advantage of being able to sit and hold out on our position. But yeah, this favourite is towards the bottom end of its traded range. We're going to back it on the basis that there's going to be a little bit of a run at some particular point, and we go into the familiar pattern of trying to establish an opening position. So we've opened or established a position within the market of around 700 or so pound, and you can see I've put the closing orders in below where we expect the price to go. And the reason that I'm doing it like this on this particular market is when the price gets past a crossover, you often find it accelerates quickly past that. So you can see me cancel and replace a few orders here in different quantities and so on. But I expect that when the price gets past 2, you'll get a little bit of an acceleration down, and that should take out most of those orders. So I've sort of weighted them towards that area at 2. And when that price goes, hopefully, we'll see all of the money get sort of mopped up below it. If it doesn't go there, then I'll just slowly exit my trades at the best price I can above where it is in the market at this particular moment in time. So you can see how sort of imprecise I am. And this is why I'm sort of taking advantage of the volatility that occurs within the market and keeping an eye on the volume down here just to see what is getting matched. But the interesting thing is, because we're past post time, the volume is going to sort of drop off a little bit. And then as the horses go to post, the volume will accelerate again. And then it will probably get the prices matched that we so desire. But at the moment we can see that the horses are about to go out on course, and as they actually approach the start, the betting will sort of get a second wind, and that will probably pull us down more into the sort of level that we're looking at. But if that didn't happen, we would just try and exit at or around the price that we're at the moment. So you can see we're a little bit further on. I've had some of the orders matched. Our net stake is down to about £300 now, feeding a few more orders in, and you can see that it's just broken down below odds of 2. And you very often see a bit of an acceleration in the market in terms of the activity at this level. And that's taking out some of those orders that we had in a little bit earlier. So yeah, we've sort of done a trade in the opposite direction here. It's slightly more complicated in the fact, or you can just see another big order going through the market there. It's slightly more complicated in the fact that the post time was delayed. But we're doing essentially the same sort of thing, but in the opposite direction. But for the same sort of reasons. Total of £89 or about £45 fully hedged. So what we did in this video is we looked at a range of markets, and then we homed in on the markets that were most likely to exhibit a trend. You may see trends in other markets as well, but we're not worried about those. What we're worried about is looking specifically at these types of markets using the criteria that we have outlined here, because we know that there are going to be opportunities there for sure. And then when we actually went in and traded these markets, we used a really simple framework to be able to do that. We just sort of said if it's at the bottom of this range, we're going to try and catch the momentum as it continues to come in. And if it's at the top, we're going to try and catch it as it goes out. And of course, you're not going to have 100% strike rate on these particular trades, but you can improve that and you can pad out any potential losses because you are going to do profitable trades here as well. But also think about the improvements that you could make. You could be looking at charts. I've done videos on what's to look for on those. You could be using other indicators within the ladder and so on. Part of that is over to you. You've got to practice that and use your skill and judgment to be able to improve your strike rate on these. But it's inevitable that you are going to have the odd loss now and again. But what you're trying to do here is when you make enough money, you're going to be using some of those profits to pay off for those times when it just doesn't work for one reason or another. But I have discussed how you can refine this going forward. What I wanted to do in this video is to give you a simple framework to look for opportunities and then come up with some sort of structure that you can practice and repeat and get better at. Anyhow, I hope that you enjoyed this video.